Have you ever wondered how the rich keep getting richer? Well, it's not just about having a high income or winning the lottery, it's about investing wisely and diversifying those investments. One of the most effective ways to build wealth over time is through real estate investment. Whether it's buying a cozy home to rent out, a commercial property to lease, or investing in real estate investment trusts, commonly known as REITs, real estate can be a reliable source of income and a powerful tool for wealth accumulation. In this video, we'll delve into the fascinating world of real estate investment. We'll explore everything from buying physical properties to investing in REITs, giving you the knowledge you need to start building your own real estate empire. It's time to turn those dreams of financial freedom into a reality. So buckle up as we take this exciting journey into the world of real estate investment. Let's break down the basics first. What is real estate investment? Well, in the simplest terms, real estate investment involves purchasing properties with the intention of making a profit. Now, this can be achieved in a variety of ways, each with its own unique benefits and risks, starting with the most common residential real estate investment. This involves buying homes, apartments, or townhouses and renting them out to tenants. The benefits? A consistent stream of rental income and potential property value appreciation. The risks? Vacancies, maintenance costs, and dealing with difficult tenants. Next, we have commercial real estate investment, which includes office buildings, retail spaces, and warehouses. Here, the benefits often include longer lease terms and higher rental income compared to residential properties. However, it also comes with higher upfront costs and can be more vulnerable to economic downturns. Lastly, there's industrial real estate investment. Think factories, distribution centers, and storage units. These can offer high yields and long-term leases, but they also require a significant initial investment and can be influenced by industry-specific factors. Now let's not forget about the potential risks that come with all real estate investments. These can include market fluctuations, property damage, and unexpected expenses. However, with thorough research and careful planning, these risks can be managed effectively. And it's not just about physical properties. There's also the option of real estate investment trusts, or REITs, which allow you to invest in real estate without the need to own, manage, or finance properties yourself. But we'll get into that a little later. So, there you have it. A primer on the various forms of real estate investment. Each option has its own unique set of considerations, and what works best for you will depend on your financial goals, risk tolerance, and investment strategy. Now that we understand the basics, let's dive into the nitty-gritty of buying physical properties. So, you've decided to buy a property. Where do you start? First things first, you need to conduct thorough market research. Understand the property market trends, identify growth areas, and look for locations with potential. Look beyond the surface, delve into demographics, employment rates, and future development plans. It's not just about the property itself, but the story the location tells. Next, you're going to want to explore your financing options. You could go the traditional route and opt for a mortgage where you pay off the property over time. Or, if you've got the cash on hand, you could make a full purchase up front. Both options have their pros and cons. With a mortgage, you can leverage your investment, but with cash, you avoid interest and have more negotiation power. Weigh these options carefully. Now, let's talk about due diligence. This is where you evaluate the property's potential. Inspect the property thoroughly, look for any hidden issues that might cost you down the line. Evaluate potential rental income. Is it going to cover your expenses and leave room for profit? Also, consider the property's appreciation potential. Is the area growing? Are there development plans that might boost property values in the future? Finally, we come to legal considerations. Property acquisition involves a number of legal processes. You'll need to understand contracts, property titles, and the closing process. It's a good idea to have a real estate attorney on your side to guide you through this complex process. Remember, every successful real estate investor started where you are now. It's a journey filled with learning, challenges, and yes, paperwork. But with patience, due diligence, and a keen eye for opportunity, you can navigate the landscape of real estate investment and build a solid wealth foundation. Once you've successfully bought a property, it's time to manage it effectively. Owning a property is one thing, managing it is another. It's like a dance, a balancing act, and the choreography involves a few essential elements. First, tenant selection. It's crucial to find reliable, responsible individuals who will care for your property and pay their rent on time. A thorough background check could save you a world of trouble down the line. Next, there's rent collection. It's not just about getting paid, it's about setting clear expectations and maintaining consistency. Then, we have maintenance. Regular upkeep not only keeps your tenants happy but also preserves and potentially enhances your property's value. Finally, dealing with unforeseen challenges. From sudden repairs to legal disputes, being a property owner can spring some surprises. Having a contingency plan and a cool head can make all the difference. But what if you want to invest in real estate without dealing with physical properties? Let's explore REITs. What if I told you there's a way to invest in real estate without buying physical properties? It might sound too good to be true, but it's not. Welcome to the world of real estate investment trusts, or REITs. A REIT is a company that owns, operates, or finances income-generating real estate, and you can invest in these companies, much like you would in any other stock. There are three types of REITs: equity REITs that own and manage real estate properties, mortgage REITs that provide financing for property purchases, and hybrid REITs that do a bit of both. But why should you consider investing in REITs? For starters, they offer liquidity. You can buy and sell shares easily. They help diversify your portfolio beyond conventional stocks and bonds. Plus, they can provide a steady stream of passive income, as most REITs are required to distribute a hefty percentage of their income as dividends to shareholders. Now, let's delve into how you can invest in REITs. Excited about REITs? Let's explore how to invest in them. Imagine owning a slice of a skyscraper in New York City or a shopping mall in Paris. Sounds thrilling, doesn't it? Well, that's precisely what investing in real estate investment trusts, or REITs, can feel like. But before you dive in, it's essential to do your homework. First up, researching REITs. You'll want to evaluate a REIT's performance over time. Look at its track record in terms of dividend payouts and capital appreciation. Also, scrutinize its financial statements. A healthy REIT should have a robust balance sheet, low debt, and consistent earnings. Don't forget to assess the quality of the management team. Experienced leaders with a proven track record can significantly impact the REIT's success. Once you're satisfied with your research, it's time to buy some REIT shares. You can purchase these through a brokerage account, much like buying stocks. Remember though, diversification is key. Don't put all your eggs in one basket. Spread your investments across different types of REITs and geographic locations. This way, you can cushion yourself against market volatility and potential losses. Now let's talk taxes. Unlike regular dividends, REIT dividends are often subject to ordinary income tax rates, not the lower capital gains rates. However, thanks to the Tax Cuts and Jobs Act, investors can potentially deduct up to 20% of their REIT dividend income. That's a pretty sweet deal. But remember, tax laws can change, and they can be complicated. So, it's always wise to consult a tax professional or financial advisor. Investing in REITs can be an exciting journey into the world of real estate. It's a way to gain exposure to property markets without the headaches of being a landlord. And the best part? You can start with a relatively small investment. Congratulations! You're now equipped with the basics of real estate investment. We've covered a lot today, haven't we? From the nitty-gritty of buying physical properties, performing due diligence, and managing them effectively, to the ins and outs of real estate investment trusts, we've taken a deep dive into the world of real estate investment. And remember, whether you're opting for traditional property purchases or branching out into REITs, the key is in the research, patience, and a willingness to learn. As we've discussed, real estate investment can be a powerful tool for building wealth, offering both potential rental income and opportunities for property value appreciation. But like any investment, it's not without its risks, and it's crucial to keep your eyes open and stay informed. Remember, the journey of 1,000 miles begins with a single step, so take that step today and start investing in real estate. Don't forget to subscribe for more investment tips and tricks, and feel free to engage with us through comments and discussions. Also, check out the recommended videos for more business and investing help.